Hello everyone. That battery can last up to 24 hours even with the always-on display turned on. It's pretty cool.
All right, let's jump right in and talk about procurement to pay, or P2P as you'll often hear it called. So what is it really? Well, at its core, it's the entire life cycle. I mean the complete journey from the second someone in your company says, hey, we need to buy this, all the way through to the very end, when that final payment leaves your bank account and goes to the supplier. Sounds simple enough, right? But as you're about to see, the reality is usually anything but.
For way too many organizations, this whole process is just a wild, chaotic mess. I mean, think about it. You've got requests flying around in emails. Spending gets tracked or not tracked on a bunch of different spreadsheets, and approvals are just an endless chain of email forwards. None of the tools are even on speaking terms with each other. It's just a recipe for total confusion.
And all that chaos, it has very real, very painful consequences. You get frustrating delays, costly little data entry errors, and those dreaded invoices that just don't match up with what was actually ordered. This stuff creates massive compliance headaches. And maybe the worst part of all, you have practically zero real-time visibility. You're basically flying blind, with no clear idea of what your company is spending or who it owes.
Okay, so that's the problem. How in the world do we fix it? Well, the foundation of any strong, modern P2P process starts right at the very beginning. It all begins with something called structured purchase requisitions. This is where we start to bring some serious order to the chaos.
So instead of that vague email that just says, I need a new laptop, automation gives you these smart, guided forms. They basically force the person making the request to provide all the necessary info, to apply the correct budget codes or cost centers, and to fill out every single required field right from the get-go. And you know what that means? No more endless email back and forth trying to figure out the details.
And here's where it starts to feel a little like magic. Once that perfectly structured requisition gets the green light from an approver, boom! The system just seamlessly converts it into a 100% accurate purchase order. No retype in, no copying and pasting, it just happens. And this is so important. Why? Because having an accurate system-generated PO is what prevents all those nagging price arguments with suppliers. It makes sure tax details aren't forgotten. And it stops unauthorized rogue purchases before they can even happen. The key here is that you're building a foundation of accuracy from the very start. All right, so now let's follow the process over to the accounts payable side of the house. We're going to walk through 5 key steps in the automated workflow: digital receiving, invoice capture, the super important 3-way match, what happens when things go wrong with exception handling, and finally, smart payment.
First up, digital receiving. This is simple but crucial. When the goods arrive or the service is finished, someone on your team digitally confirms it. That action creates what's called a goods receipt note, or a GRN. It's a critical piece of the puzzle. It's the proof that you actually got what you're about to pay for. Next, the supplier's invoice arrives. Now, in the old world, this is where someone's day gets really tedious with manual data entry. But with automation, nah. The system takes over. Using technology like OCR and AI, it literally reads the invoice, pulls out all the key information, and digitizes it in an instant. That entire mind-numbing task is just gone. And now for the main event, the automated 3-way match. This is really the moment of truth. The system plays detective. It takes the purchase order, what we agreed to buy. It takes the goods receipt note, what we actually received. And it takes the supplier's invoice, what they're asking us to pay. And it compares all 3 to see if the story adds up. Now, in a perfect world, everything matches. The price is right, the quantity is correct, it's all good. When that happens, we achieve the holy grail of efficiency, straight through processing. The invoice just sails right through the system, gets approved, and is posted for payment without a single human being having to touch it. That is the goal.
But let's be real, life isn't always perfect. So what happens when there's a mismatch? You know, what if the price on the invoice is higher than what was on the PO? Or they only delivered 8 items when we ordered 10?
This is where a smart system really proves its worth. It doesn't just crash or throw up a generic error. It intelligently routes that specific problem to the exact person who can solve it. Price issue? It might go to the procurement manager. Quantity problem? It routes to the person who received the delivery. It finds the right owner fast.
Underpinning this whole thing are automated workflows. You can think of these as the digital guardrails of the process. They guide every single step, they automatically enforce your company's spending policies, and, this is absolutely critical for finance teams, they maintain a perfect, unchangeable audit trail of every single action that's taken. Okay, the invoice is finally approved. We are in the home stretch. Time for smart payment scheduling. The system makes sure you pay on time based on your supplier terms. It automatically flags any chances to grab an early payment discount, and it enforces all your compliance rules right up to the very end. You know, one of the biggest payoffs in all of this is visibility. For the first time, all this data is flowing through one system, which means you get real-time dashboards. Finance can see your liabilities building up in real time. Procurement can track cycle times, and your leadership team can finally spot bottlenecks before they turn into major problems. So when you put all these pieces together, what do you really get? I mean, what are the ultimate outcomes here? You're not just making a process faster, you're fundamentally creating a financial process that is truly scalable and way more strategic. Just look at this comparison. The first huge outcome is just a massive reduction in manual effort. You go from a process that drains your team's time and energy to one where they only focus on the valuable stuff, the exceptions, not the tedious data entry.
The second big win is a giant leap in accuracy. When you take manual keying out of the equation and just let the systems validate the data, you get rid of all those tiny human errors that can snowball into big financial problems down the road.
And third, you get seriously strengthened compliance. Because your business rules and your approval limits are baked right into the system, every single transaction is forced to follow policy. The process enforces compliance by its very design.
So the real takeaway is this: when your P2P process is fully automated, you transform a chaotic reactive function into a predictable, scalable, and strategic financial engine. It gives you control, it gives you visibility, and it gives you efficiency. Which really just leaves one final question to think about: is your process there yet?